Okay, good afternoon and welcome to the latest in the IMAP series of webinars. It's a pleasure for us today to have Lukasz de Pourbaix from Lonsec joining us to talk about portfolio construction in volatile markets. My name's Toby Potter and I chair IMAP, and I'd like to welcome all of you to the webinar today. Before I ask Lukasz to take us into the content, I'd like to just talk a little about the upcoming events that IMAP is going to be holding between now and Christmas. It seems strange at this time of year already to be talking about Christmas, and I've got to tell you that it's a distressingly close period for us. So first, I want to talk a little about Investec, and I'll say more about that in a moment. But upcoming investment events that we'll be holding over the next couple of months are Sydney and Melbourne based. So in October, we'll be developing the themes that come out of today's webinar with Lukasz, a private investment consulting from NAB and Antares, and talking about portfolios for turbulent times. Each of the three presenters has developed their issues, and we'll be drawing those together in a consolidated view as to how advisors might work on building portfolios for times that could well turn out to be much more troubled in 2019 than the relatively peaceful times that we've been through so far. But Lukasz will talk more about that shortly. Later in October, State Street Spiders will be, Jonathan Sheed from State Street Spiders will be talking about retirement reality for both an Australian and global context, and how managed accounts can be part of developing retirement income solutions. And then in November, I'm really happy to announce that we'll have Stanford Brown and BlackRock taking us through what it takes to develop a managed account program within an advice business. Stanford Brown were the winners of the inaugural IMAP Managed Account Awards, and Jonathan Hoyle and Ashley Owen are respectively CEOs and Chief Investment Officer for Stanford Brown, will be talking about both aspects of building a managed account program: the business of managed accounts and the investment management of managed accounts, when the key sponsor for the managed account program is the licensee itself. Our next webinar will be coming live from the FPA Congress. IMAP hosts at the FPA Managed Account Central, where a number of our managed account providers and investment managers will be participating. And so if you're planning to attend the FPA, come along and talk to the participants. And as I say, from the FPA, we'll be running a best interest webinar. A little about Investec. So technology is one of the key enablers of managed accounts. It's the thing which has made it possible to run many portfolios concurrently. And it's in its broader context, it's both a disruptive and transformative force for advice businesses. So Investec's being held on the 8th of November. This will be our second Investec conference. And amongst the topics are picking partners, how to choose a technology and outsource administration provider. John Barton from MGD, a Queensland advice business, will be talking about how he's put together his view of what a technology stack for an advice business looks like. We'll be talking about the connected world. What does open data mean for advisors? Open data is coming to banking, but it's going to have real consequence for advice businesses. Advice businesses are living in a data-centric world, and it's a good thing for advisors and licensees to understand what that means. I've asked a number of fintechs to hold a TED talk, if you like, 15 minutes on what we do. So you'll get a chance to see what CRMs can deliver, the new model CRM, and portfolio management technology on how many portfolios can be managed concurrently. And one of the sessions will be a workshop approach for advice businesses and licensees on choosing technology, how to analyse what your needs are, and how to compare what's available. And then briefly, I just wanted to say a little about three of the communities of interest which IMAP supports for its subscribers. A data group is working together, primarily providers, some investment managers, to develop common data standards across managed account providers and investment managers. We've recently established a regulatory group within ASIC, chaired by Adam Seckham, and with participation from Macquarie and Praemium, from the Fold Legal, Holly Nethercote, both lawyers, and Stuart Chandler, who's a compliance specialist from Western Australia. And as a group, we met yesterday with ASIC to talk about some of the issues around documentation for managed accounts. It hasn't been widely reported yet, but ASIC in their corporate plan for 2019 have announced that platforms and MDAs will receive particular attention as ASIC thinks through issues of conflicted remuneration and vertical integration. So IMAP is on the front foot in terms of engaging with ASIC to make sure we understand the things that are important to them and that we're able to pass back to the managed account community what best practice looks like. The other thing which we'll be establishing in 2019 is an investment advisory group. And we'll be inviting a number of leading research providers, investment managers, portfolio management teams to participate in that, to make sure that the topics that we present on and the information we provide is relevant to the investment management process in establishing managed account programs. So without further ado, let me pass over to Lukasz to take us through portfolio construction in volatile markets. Lukasz, thanks very much.
Thank you, Toby, and thank you everyone for taking their time out during lunch, I guess. Appreciate taking the time. So the topic today is portfolio construction in volatile markets, and it's been an interesting period over the last several years where certainly volatility, on a variety of measures, has been at all-time lows. However, we are seeing now sort of evidence that volatility is increasing, or the frequency of volatile events is increasing, which both creates opportunities from an investment perspective, but also poses some risks. And it's important to have a think about in your own portfolio construction approach, or whether you're partnering with a managed account provider, what are some of the key things to think about. So today's presentation will go for roughly around half an hour. In terms of the key points, I'll talk about where we've been at in terms of volatility. What are some of the key things that we think are contributing to volatility and are likely to continue to contribute to volatility? And that's really around policy, geopolitics, and asset valuations. And then thinking about, from a portfolio perspective, given that we may be moving into a slightly different environment in terms of volatility, what are some of the key things to think about from a portfolio perspective? Here's our disclaimer. One of the measures that many of you will probably be familiar with, you may use it within your own internal sort of investment committee process, and it's one of the factors that we use to have a look at volatility, is the VIX index. So the VIX index is basically a measure of implied volatility for the options market. This is for the S&P 500. So it's a short-term sort of forward-looking view on volatility in markets. And over the course of the last year, it's ranged probably at a low of around 8 to a high of around just over 30 in February early this year. But we have seen, but despite this, it sort of remains fairly low. Certainly if you compare it to the 2008 period, where we had that GFC period where it hit past that 80 mark. In terms of the contributors to this low volatility environment, there's been a few. So if you sort of step back in that sort of post-2008 period, central banks underwent a massive, I guess, buying a quantitative easing program, basically buying up bonds, providing a lot of liquidity into the markets. From a interest rates perspective, easing monetary policy, basically creating cheap debt, and pumping a lot of liquidity in the market. And all of these things have been very conducive to markets. And it really also forced a lot of people to go into risk assets, because if in an environment where rates are very low, bond yields are going down, many mums and dads out there had to go into risk assets to generate some kind of return. So the culmination of all these things created a sort of environment where, you know, equity markets, but really all investment classes have been characterised by fairly low volatility up until recently. And we think that environment is maybe shifting, and there are, I guess, a couple of key things that will contribute to that. Probably one of the, I'll just change slides. One of the poster childs for this sort of period of low volatility has been the US market. So the US market has been one of the strongest performing markets in recent years from a global perspective. And you can see in that line, it's been pretty much one-way traffic for US equities. Now that's been a function of several things. So for 3 years, I mean, I think, you know, if you've had exposure to the US markets, you've had strong double-digit returns over 3 years, which has been great for investors. And that's also been, the US market has been a key contributor to global markets in terms of returns more broadly. The key drivers of that, as I mentioned, has been very accommodative monetary policy, easy debt. So companies have been able to access cheap debt as a result of that. Plus, you've had, from a political perspective, and certainly with Donald Trump taking the presidency, he's also come in with, you know, certain policies that have been very conducive to the corporate sector, such as the corporate tax cuts. All of these things have and provided a strong tailwind for US equities. And coupled with that, the US market has also been exposed to sectors that have been, you know, the post the child in terms of returns. So probably the main one, obviously, the tech sector. If you think about the S&P 500, probably about 26% of that index is made up of the tech sector. And some of you may be familiar with the acronym FANGs. It's sort of been doing the rounds of these are the stocks that have, you know, really been driving markets. And that's notably, you know, your Facebooks, your Amazons, Apples, Netflix, and Google, what's known as Alphabet these days. So if you look at something like Netflix, they've had over 90% returns over last year. Amazon's had over 50%. So not only have you had a whole sort of tailwind of positive factors, then you had sectors that have been really driving returns as well, as I've sort of discussed. But it hasn't been the same across the board. So here we've got the MSCI Emerging Markets Index, and in 2017, emerging markets one of the best performing sectors in the market. But in recent times, we have seen those markets pull back quite materially, and that's been on the back of a couple of things, some idiosyncratic country-specific issues, which I'll talk about and give some examples in, but really a combination of a lot of things. We've had the US dollar rise, which traditionally has been not a good thing for emerging markets, but you've also had some geopolitical issues and things like trade wars, which are having an impact on markets, not just emerging markets, markets more broadly, and creating volatility. And emerging markets typically are higher beta market, higher growth oriented markets. So you're going to see volatility in those higher beta markets. That's where you sort of see it pop up initially. In terms of central policy, I did mention obviously that central banks underwent a massive quantitative easing program, one to stabilise markets, obviously, post the GFC world. Now, this is a chart courtesy of Pendle, and you can see quite clearly that The unwind of that policy is happening. They're not buying up bonds as much. The Europeans are also going to announce that they're going to sort of be decreasing their program of QE. So the question is, and that is, so a couple of, I guess, things to come off the back of that. The rate of liquidity being pumped into the markets that's been supported markets to the last degree is coming back a little bit. We are seeing rates also, particularly in the US, go up. So the question is, one of the sort of other things being the access to cheap debt. Now, the question is that cheap debt going to be continue to be available for corporates, which has for some companies been a key contributor to their growth. And so we are, I guess, in some uncharted waters at the moment in terms of QE and an unwind. We haven't had this type of environment again. But again, a pullback in liquidity is going to potentially create more volatility in markets, which is going to create more dispersion in returns between asset classes, individual securities, and regions going forward. Geopolitics is another one. Now, geopolitics is an interesting one in that geopolitics is always there. I mean, it's not a new thing. You know, over time, geopolitics can influence markets. You know, North Korea's been, you know, was last year's sort of hot topic. But probably one of the changes we sort of see is that geopolitics, it's become much more of a competitive type environment. We've seen obviously a lot of political changes over recent years. We've seen the rise of populism, really underpinned by a growing perception and reality of inequality in wealth. So while markets, for example, we saw that chart of the S&P 500, markets have been fantastic, but it's really, in terms of really who's benefited from that, it's been a small part of the public that's really benefited from that. You know, your normal punter from the street hasn't benefited. They haven't had strong wage growth, and probably feels disaffected by mainstream politics. And you've seen that in things like obviously President Trump coming to power in the US, Brexit, but you know, you're seeing that across the globe. So some of you made, you know, if you look at Europe, for example, in Italy, Matteo Salvini, one of the populists, is gaining traction. In Sweden, we just had elections recently. There's very much a, you know, historically social democrats have dominated there, but you are seeing the right-leaning parties gain traction. So you are seeing a rise of that, and that is creating a bit of uncertainty and risk. And if you look at, you know, Donald Trump is really the poster child for that. But you can see in terms of how he operates, and the trade wars are a good example of that. That is having a direct impact on markets. So every time President Trump makes an announcement, whether it's to do with China, we just saw one recently in terms of increasing tariffs on Chinese imports, this is causing wobbles in the market, but it is having a real impact in terms of, so if you think about China, you know, that is still, despite the desire for China's economy to be more focused on internal consumption, it is very much still an exporting nation. And this is having an impact on China's own fiscal position as well. And then from a bottom-up perspective, it is having an impact on individual companies. So you can see there, I've got the Harley Davidson motorcycles. Now, the reason for that is not only has Trump been sort of putting, I guess, tariffs on the Chinese, he's also had a crack at the Europeans. One of the increasing tariffs on European goods, particularly cars, was a good example where I think the tariffs were around 6%, they were increasing to over 30%. So in retaliation, the Europeans said, well, we've got tariffs on motorcycles from the US, we're increasing those tariffs. And Harley Davidson obviously is a well-known motorcycle brand. And if you look to the next slide, this is the HOG is actually the code for Harley Davidson, and you can see sort of just above that 2018 period. You know, once sort of those the Europeans sort of retaliated with those tariffs, you could see that share price come down quite a fair bit. So it's not only sort of political jousting; it is actually causing volatility. And if these sort of trade wars become a systemic issue, further down the road, it is going to have an impact on global growth. And so that is what I guess the market is trying to navigate to, and what's contributing to the volatility is to what extent is this political jousting, to what extent is this a more systemic strategy. And you're seeing the effects of even yesterday in terms of retaliation. The Chinese, while they haven't sort of, they're going slow on US imports. So even from a soft perspective, when they're checking American goods, they're taking their time and so forth. And so these things are contributing to trade wars, and certainly the political sphere more broadly is having an impact on markets and causing share prices to move around. You can see this is just another sort of tongue-in-cheek one in terms of the whole tweeting by Trump, where he tweets about certain companies. What initially causes volatility, but interestingly, this one you can see that when he's attacked companies after the initial hit, they actually have outperformed over the 1 year. And these are examples of sort of well-known brands that he has tweeted in the past. But again, it's causing a lot of noise. It's causing disruption, which is adding to the other things as quantitative easing rolls back as well. Now, emerging markets, I mentioned that we have seen increased volatility in emerging markets. Now, it's an interesting sort of test case because this is really a combination of a range of things contributing to volatility. So it's not only, so if you look at Turkey, there's a couple of issues there. One is obviously the President Erdogan, who recently reaffirmed his power. He also extended the presidential powers there, which caused a lot of, I guess, market wobbles. And you saw a massive outflow of capital out of emerging markets. Coupled with that, the fiscal position, you can see on the chart on the right-hand side there, on the left-hand axis, the current account position for Turkey has been quite poor. And you've also seen on the bottom axis the currency pull back quite aggressively. So it's really been an interesting one of poor fiscal position, political uncertainty in terms of, is it moving more towards an authoritarian type of environment, which I think the consensus is, yes, it is. And they've also had a bit of a tiff with the US as well on a political front, and the whole sort of tariff things come up as well. So it's really been a combination. And so the interesting thing is this idiosyncratic thing? It's certainly causing volatility, but you've seen issues in other countries like Argentina, for example. China, you've seen more volatility. And so while some of these issues are specific to countries, the reality is if investor behaviour, if they start pulling out capital, it can spread. Now, we're not seeing that at the moment across the board, but it is something to keep in mind. And keep in mind that, you look at Turkey, there are a lot of banks, European banks, for example, that do have material exposure, not only to Turkey, but some of these other emerging markets. So it's important to keep in mind, but it is certainly one area that we're seeing more volatility in markets in recent times. And you can see here in emerging markets more broadly, the left-hand chart there just shows you sort of exposure, so you can see that emerging markets are very much linked to global trade. So, think ahead. So if you see some of these trade wars continue to unwind, continue to this type of environment, and subsequent to that, global trade starts pulling back, emerging markets are going to be hurt. On the right-hand side, you can see the beta to the US dollar. And again, as I mentioned before, you've seen the US dollar rising, which has also been negative for emerging markets. So it's a couple of things, I guess, headwinds facing emerging markets. But on the flip side, valuations have certainly pulled back and become much more attractive in that market. So talking about valuations, so if you think about valuations, I mean, valuations are a long-term indicator. So, things can be expensive for a long time and things can be cheap for a long time. So valuation does tend to be more of a 3 to 10 year type signal in terms of markets. But it's probably, if we've got our view is that valuations across the board are either at fair to expensive. The market that is clearly showing up the most expensive is the US market at the moment, and you can see obviously that the market has been a very strong performer. However, momentum continues to be strong. Some of the economic indicators, such as PMIs, for example, we just saw the latest numbers come out for August, continue to expand. I think the US economy has 112 months of growth, continuous growth. So valuations are stretched. However, the broad some of the economic indicators continue to be positive and momentum continues to be strong. So while we do think we are probably heading to the later stages of the cycle, the question is for how long, how long does that cycle last? So the key thing is to start thinking about, are there any other risk factors starting to appear? So things like, is the yield curve, we're seeing the yield curve flatten. If we see that sort of tip over, what does that mean? So inverted yield curves usually are followed by recessions about 12 months after that. So these are some of the things you want to look at more broadly. From an Australian perspective, again, the market isn't specifically cheap as well. We've had volatility as well, but for, I guess, different reasons. We've had obviously the banking sector more broadly pull back quite aggressively, and a bit more volatility in some of those sectors as well as some of the telcos. But valuations, from a valuation perspective, it's fair to say that nothing's really been cheap at this point, which is contributing maybe to some of, it's just another factor that creates tension in markets. So if you sort of summarise from a volatility perspective, markets have been really good. So investors have done really well, and that's important to the average and sort of balanced client has had a very good outcome generally over the last several years, as most asset classes have done really well. But we are seeing volatility pick up. Now that's being driven by three factors: policy, so central banks unwinding, geopolitics, we're seeing a more competitive period in geopolitics and uncertainty, and finally, valuation. So these are the three things that are sort of contributing to volatility. So when you're thinking about your own investments, it's important to have some kind of framework. From an asset allocation perspective, these are some of the key things we look at. So we look at obviously valuation, which valuation does tend to be a longer term indicator, as I said, but then trying to understand where we are in the cycle. So looking at things such as the output gap, looking at some of those indicators such as PMI, looking at the unemployment rate, looking at, I guess, a variety of factors that give you some indication of where we are in the cycle. From a shorter term perspective, looking at things like sentiment and momentum as well, because while momentum can carry markets, I guess, for a while, and it's important to be cognizant of that. But then also understanding from a bottom-up perspective, from a research perspective, what is happening on the ground. So, one of the things interesting that from our own investment committee that we were speaking about recently is from within the Australian market is the some of the costs from a bottom-up perspective for companies going up. So, which may have an impact for EPS growth, as an example, going forward for certain parts of the market. So overlaying that with really strong bottom-up research is very important, and certainly part of what we do in terms of leveraging our broader research team and sector specialists within our investment committee process. In terms of the building blocks, there's different ways you can sort of construct portfolios. So asset allocation framework is one. Then in terms of your investment selection, there's different, as I said, ways to construct it. But the way we sort of think about it is to sort of say there's broadly three components that we look at. So one is, what is our exposure to beta? So beta is effectively exposure to the market. Now that may be via passive strategies or active strategies, but effectively long only exposures to the market. Now beta has done really well in recent times as the market's gone up. If you've purely been exposed to beta, that's been worked really well in recent years. The question is that going to work as well if we go into a period where there's more market dislocation? The other key component is risk control. So this is, what is your exposure to strategies that can manage risk such as market risk, so specifically downside risk. And I'll go into more detail there. And then finally, higher alpha strategies. So things like long short, small caps as an example. But that's a bit of a broad framework as to how we sort of think about it. And that just sort of fleshes that out, what that may look like in terms of beta. That could be passive, could be factor investing as well, or active long only. In terms of that risk control, could be equity strategies that vary their market exposure either by going into cash or more absolute return strategies. And on the alpha side, long short, small caps are an example of where we're looking. And from our perspective within our portfolios, we have increasingly been allocating to the risk control strategies and also more alternative strategies as well. And that's really just the function that we do think that things are still looking okay for markets, but as we see more dislocation, more volatility, we want components in the portfolio that can help manage some of that volatility and risk in markets. These are just some examples of some strategies, and you can see these are both of the equity strategies, very different from each other, but you can just see the beta to the market. So if you're exposed to a passive strategy, you'd expect your beta to be 1. And here you've got AB Volatility Equities Fund in that blue line, and then the Allan Gray Aussie Stable Fund as an example, which can go into cash pretty aggressively. But you can see the exposure to the market is either can be very low or very, and we do use these type of strategies as an example to act as a bit of buffer in addition to asset allocation. So it's important to think about what mechanisms in your own client portfolios do you have that can act as that buffer if we do see volatility go up or if you see a bit of a pullback in markets. It's also important to understand what your exposures are to market from a factor perspective. And there's different ways to cut factors. This just shows the MSCI index and which factors have done really well in different periods. You can see over year to year, momentum has certainly done really well, which again, if you look at, say, the US market, where it's been one-way traffic, that's actually quite intuitive that momentum has done well. Quality's also been another area which has done well. And some of those FANG-type stocks fall into that quality bucket. And it's fair to say, obviously, you could argue that some of those are they expensive? That's a question to ask. But I think the key message here is in a market that has done really well in recent years, and there's certain things you could take. So, for example, growth type strategies in the equity space in the global perspective have done really well. And in your own portfolios, it's just ensuring that you're not overly exposed to a single cluster, a single factor that is really driving your portfolios. Because if you do see the market change, those factors may not do as well. So it's important to diversify within your portfolios, understand what your exposures are, and ensure that you've got that diversification. And the same thing with bonds. So bonds, not very topical, obviously, at the moment, because if the view is that it's been one part of the market where a lot of people have said it is expensive for some time, but bonds have continued to play that role in the portfolio where they have, despite yields being low, they've still been a diversifier to equities. And that is the primary role within the portfolio. The argument is, will they continue to diversify as much as they have in the past? We still do think they do have a role. So government bonds still do have a role. At the same time, the bond market, we've seen a proliferation of new product come into that market. You've had unconstrained bond funds, which really range from traditional bond funds, credit long-only bond funds to hedge funds and everything in between. And there's other strategies under the bond category, such as whether it's credit or loans, which there's nothing wrong with those asset classes, but they are more correlated to the equity market. You can see on this chart, I've taken two actual funds. One is a very traditional fixed income strategy, a duration-based strategy. The other one is a credit-based strategy. And you can see the correlation to equity markets, in this case, the ASX 300. So the traditional bond fund is negatively correlated to equities, which you would expect. but your credit-based strategy in this case is actually very highly correlated to equity markets. So if you do see more volatility in equity markets, for example, or if you do see a pullback, understanding what type of exposure you have within the context of your bond strategy is important. What have we been doing in terms of our own bond allocations in the portfolio? We continue to have some exposure to duration. We haven't sort of said, well, duration's expensive, we don't want any duration. We still do think duration has a role to play, but we have been increasing our exposure to more absolute return strategies, pretty much short duration, at the short end of the curve, and not really at the, at that more conservative end, just to diversify some of that duration should we see rates go up. But it's getting that balance right and understanding what your correlations are, because you don't want to have too much exposure to bonds that are really highly correlated to equities, and then these equity markets get the wobbles, that you're getting a double whammy, so to speak, in terms of your portfolio. I won't spend too much time on this, but I guess in terms of our own investment philosophy that we apply within our managed accounts, we do seek to, I guess, generate those long-term returns. We have, but with a focus on downside risk. So I mentioned that we look at some of those risk control strategies within our context of the portfolio to really be that anchor on protecting the portfolio from a volatility and downside risk protection. And in addition to that, from a broader asset allocation perspective, we're also looking to make tilts at certain points in the market to add some incremental value, but also mitigate risk within the portfolio. So ideally, we get an outcome where we keep pace with the market, and then hopefully we get more downside events that we do better in that type of environment as a result of the process. In terms of just if you look at that sort of our main sort of balanced option, and this just gives you some quartile performance. I think from memory this is at the end of June, and you can see from a performance that is relative to a FE peer group. So peer groups have the limitations, but it just gives you a bit of indication of relative to other sort of balanced strategies in the market. And performance has been quite strong. As I said, typically would expect to keep pace, but maybe lag a little bit. From a volatility perspective, we've been third quartile. So you think about sort of reversed in a way. So third quartile in terms of volatility and third quartile in terms of downside risk. So I guess that the outcomes have been fairly consistent in terms of the process. So the key things I think it's important to think about is that we do think volatility is increasing. QE unwind is in play. Geopolitics is becoming more combative now. You don't want to make portfolio moves based on geopolitics, but you want to be, it is contributing to volatility, and valuations are fair to high. Having a clear investment philosophy in this type of environment is important, and process, and also a clear governance structure in terms of the investment committee. And what is that? What is that process? I've sort of stepped through some of the things we think about, and research is important. So you need that bottom-up research if you're going to select investments. It's key in terms of that decision-making process. In terms of the environment going forward, greater market dispersion will be more conducive to active managers. So if you get greater market dispersion, focus on being able to identify those bottom-up opportunities is going to be important. It doesn't mean to say that being just exposed to an index or passive, you don't do that. I mean, that can have a role to play, but dispersion will create more opportunity. So, and having a dynamic approach will be important. And the key thing I'd say is diversify your portfolio by strategy. Understand your factor exposure. So what has worked in the last sort of 5 years or more may not work as well going forward. So just ensure that you're not sort of on a one-way train. And again, seek uncorrelated assets, because as you've had in an environment where all asset prices have gone up, where you've had low volatility, it does sometimes hide some of the risks. And if you get more dislocation, you need those diversifiers to work for you within your portfolio. So understand that. So they're the key things I want to discuss today. And certainly I think there's an opportunity to ask questions.
Yeah. So thank you, Lucas. That was great. If you want to ask a question, just open up the chat on your presentation, and type it in. There are a couple in there already. Will we get the presentation slides? Yes, IMAP will be putting up a recording of today's webinar and the slides during the course of the afternoon today. And a comment from Brian Thomas. Who the hell is that? A well-known man about Investment Town. His question is, isn't the key to the future of markets the pace of interest rate increases? Does Lonsec have a view on what the new neutral rates are going to be?
Yeah, so no, you're right. I mean, the direction of interest rates is going to have a material impact. Obviously, it impacts interest rate sensitive sectors such as bonds, listed property, in terms of cap rates, and it certainly can impact equity markets as well. So our view from an Aussie perspective, we discussed this yesterday in the investment committee actually. So we don't think there's going to be from an Aussie perspective a shift upwards anytime soon. We have obviously seen outside of the RBA sort of cycle, banks themselves increase rates on residential and investment loans as well. So we don't see, that's not our base case, is that rates will sort of remain steady from an Australian perspective. From a US perspective, look, at this stage, we're not seeing any evidence of out of control inflation, which would warrant a rate rise outside beyond what's expected. So I think the current rate rises in the US have been in line with expectations. I mean, inflation is an interesting one. So I guess there's sort of cyclical inflation, which you've seen some pockets pick up. In terms of that structural inflation, we've actually seen some deflationary pressures. So things like contributing to that is the aging population, technological advances as an example. Some of these things have been counter to inflation. So that is, you're right, that is, in terms of Brian's question, that is a key thing we're watching.
Yeah, there's a good argument which I was reading yesterday in The Economist, Lawrence Summers' view that we're actually still in a structural deflationary environment, and we should be positioning portfolios for a world characterised by falling prices.
Well, the other interesting thing to think, so QE at the moment we're seeing an unwind, but realistically, if we were to see some kind of material market event, now, while there's not a lot of that, the US could, they could sort of employ that as well. Again, so there's nothing to say that it's the end of QE. We are seeing that unwind, but again, and that may have an impact on rates as well. So it's I mean, at the moment, it's been in line with expectations.
Yeah. So there's a question. The questions are flooding in now. So let's just pick up on a couple of these. What do you think the risks is of bonds and equities selling off together? And I think you touched a little on that on the kind of classification of bonds, credit versus duration.
Yeah. Look, you can have that environment. So the question is, are bonds still the diversifier? I mean, where we've seen markets, where we've seen sort of pull back bonds, how bonds have traded, they have still been a diversifier to date. There might be some environments that doesn't occur. I mean, where we've been looking, so if you look at from a more dynamic perspective, our key sort of overweight exposure is more towards the alternatives sector. And that is where we're looking to add that further diversification within the portfolio. So if we do get that dispersion, being able to employ other ways of diversifying the portfolio through different trading mechanisms, whether it's relative trades, as an example, within the portfolio, that's where we're also looking to add diversification.
And this is using funds which specifically target those strategies.
Correct. So our sort of core position has been sort of the multi-asset type alternative strategies. Now, they haven't really done that well in recent times, but at the same time, we've had bull markets. So the test will be when we get some more volatility, and that's when we should see some of these things come to fruition.
There's a question here from Tanzim Khan on inflationary pressures, and we've touched on that a little. Tanzim saying that everybody knows that inflationary pressure is rising, but I think is that an assertion you actually agree with, that inflationation pressure?
Yeah, it is. It's not rising everywhere. I mean, you look at the US, there are some inflationary pressures. From an Australian perspective, we still haven't seen wage growth, right? So it's not. I think there's, you've got to look at it from a, it's not the same everywhere around the world. We are seeing some, to my earlier comment, some pockets from a US perspective in cyclical inflation, but then there are those structural elements that I guess are countering that to a degree. So from a portfolio perspective, we haven't, specifically taken a hedge on inflation. We have some asset classes which have, such as infrastructure, for example, that historically has been not a perfect hedge, but is correlated to inflation. You've got other things such as inflation linkers from a bond perspective, which we haven't actively gone down. They've already priced, I guess, arguably priced in some of that already in the price. But there's some other ways to think about inflation.
I guess my question, just to wrap this up, I'm conscious of time. My question is the difference between protecting a portfolio against the general rise in volatility, volatility moving up towards sort of 1 to 2 times, standard deviations and so on and so forth, versus protecting a portfolio against catastrophic loss. The risk that we'll have another, that we'll have another GFC, that for example, the euro will fail.
Yeah, and look, it's one of those things. So it's those things are difficult to predict. I mean, you sort of, it's an interesting one. I mean, I think you've got to. I would argue you always want some kind of, something within the portfolio that can potentially act as a diversifier, that can maybe act as a buffer, and you add that incrementally as you see risks go out. In terms of that sort of pure catastrophic risk, I mean, there have been strategies out there specific for that type of risk. The reality is, though, that you're paying away, you're paying up big time, and hopefully you get the payoff when that event happens. But people have, for example, been saying bonds have been expensive for the last 5 years or more, which they have been on traditional valuation measures, but they've continued to do okay. So you just got to balance that off, and you'd probably have a small exposure if you were going to go down the route of having specific, that real tail risk hedge in the portfolio. You'd have, just have a measured exposure, and it's probably not a structural exposure within the portfolio.
Yep. So a bet that Salvini and the League in Italy don't actually get a chance to pull Italy out of the euro.
Yeah, it's fascinating. I mean, I mean, the whole European situation with Brexit on top of that political situation, you've seen obviously Hungary get the sort of rap on the knuckles as well. Yeah, recently. So if you want to watch something entertaining, watch the European Parliament.
Yeah, when you're not watching the Royal Commission.
Exactly.
Oh, look, Lucas, thanks. There is a question on: do we have the TIPS sort of funds, inflation protected bonds?
So there are some funds which have exposure within their portfolios to that, and the names escape me at this point. Yeah. But there are some that do have that.
Yes, but it's a pretty small aggregate pool of inflation
100%,
protected.
Yeah, it's not a big pool of funds. Yeah.
Look, thanks very much, Lucas, and thank you for those of you who've participated in this. As I mentioned, we'll put up slides and a recording of today's session on the IMAP website. So thanks very much.
Thank you.